Yeah, welcome to my video blog Questions of Doubt in Corporate Valuation. My name is Bernhard Schwetzler, and today's question of doubt is how can I distinguish between promised yields and expected yields when deriving the cost of debt for corporate valuation? So this is more or less a leftover over our last week's QoD, where we already learned to distinguish between promised and expected yields. So this is a short wrap-up of the results then. So the bond yield relates the promised payments of the bond to its current market price and calculates the IRR. But this is not what we mean when we are looking for the cost of debt, because this figure, as it relates the promised payments to the current bond price, is in that sense not considering and taking into account the risk of default. Yeah? So what we actually need is the expected yield or the expected rate of return on the bond. Yeah? And this is, of course, taking the potential default of high yield debt into account. And that was our example at the end of our last week's video. That was, we had an IRR of 16.9. That was the yield of this bond at the current bond price. And that has to be multiplied with the probability that the firm or that the bond is actually in a position to deliver what has been promised. And with a 5%, the counter probability, you lose everything. That means your rate of return is minus 100%. And that is then translating into an expected return or expected yield of 10.25%. Yeah. So the question that was left over then was, how do we get to these figures? Yeah? 16.9, 10.25, and actually, and I noted this at the end of this last video, we unfortunately need an option pricing model to calculate these figures. Yeah. So, and this is what I owe you to in our today's video. That is, I would like to show you a very simple, basic option pricing model, just to highlight the idea that is behind this expected return and cost of debt approach. So the basic idea is that that is not mine, of course. So that goes back to several Nobel Prize winners, Bob Merton, Fisher Black, and Myron Scholes. They found that under limited liability, the firm's equity corresponds to a plain vanilla call option written on the underlying of the corporation asset value, of the firm value of the firm. Yeah? So this is nicely highlighted here by this graph. Yeah? So in a one-period model, very simple, the claim of the debt holders is, of course, interest plus redemption. And of course, if the value of the total firm, of all the assets of the firm, is below the claim of the debt holders, then of course under limited liability, the equity holders do not get anything. And so then, if the value exceeds the claim of the debt holders, then of course the equity holders kick in and get what is left over from the value of the corporation. And if you look at the payment structure here relating to the value of the assets as being the underlying, then you see that this is clearly visible here, a call. Yeah? And on the other hand, the consequence is that risky debt may be also modeled in a sense based on option pricing theoretical considerations, but because the debt here, the risky debt, may be modeled as a portfolio out of two securities. The first one is the riskless bond, and you see here this is the part one, yeah. And the second one is a short put, because here you see this is the claim of the debt holders, and if the value of the assets of the corporation is lower than the claim, then of course the debt holders are left with what is left over. Yeah? So in that sense, if the value of the assets is lower than the claim, they just get the value of the assets. Yeah? And if you look at this, then you see that the second component can actually be modeled as a short position in a put. That means that they have to take back the asset value of the firm if the value of the firm is lower than their claim, yeah? Because then this is just what they get. Yeah? So their total debt position may be modeled as a portfolio out of these two components. Yeah? Component one, riskless bond, and component two, the short position in the put, that they have to take back the value of the assets. Yeah. So I just would now show how a simple option pricing model may be used in order to value these two option-like claims of equity holders and debt holders. Yeah. So we start out with a completely equity financed firm in a world without taxes. The riskless rate is supposed to be 10%. The current firm value is given, so it is 100, and it is uncertain in the next period. It either goes up by 50 to 150, or it goes down to 50 from 100. Yeah. So you see here, this is the distribution, the potential distribution of the value of the firm in the next period, and this is its current value of 100. Yeah. And so the idea is now that the shareholders want to sell debt with a value of 55 to the creditors. Yeah? So the idea is that we try to shape the conditions, and especially here the promised interest of this credit contract, in a way that the creditors get what they pay for. That means that they bring 55 to the table, that is their debt, and the market value of the debt should also be 55, that is the market value of the payments that they are entitled to get under limited liability. So in that sense, the key to understand this pricing idea is that the net present value for the debt holder and the creditors of this deal is equal to 0. So they get what they pay for. Yeah. So, and the first step is that we somehow try to adjust, not somehow, but we try to adjust, calculate the risk-adjusted promised interest rate that meets this requirement. Yeah. So if we look at the potential distribution of the debt holders, they bring 55. In the bad state in the future, they, due to the limited liability, they get what is left over. So they just get the 50. Yeah. But in the good state, they get their 55 back. This is the redemption. And on top of this, they get this promised interest rate. So their claim is then, or what they get as a payoff is 55 times 1 plus the promised interest rate. Yeah? And you see here the opposite side of the coin for the equity holders. You see their value is here 100 minus 55 is 45. So if the bad state occurs, then they get nothing because the entire firm value is paid to the debt holders. And in the good state of the world, they get the 150 minus what they have to pay to satisfy the debt holders, that is 55 times 1 plus the promised interest rate. Yeah. So the idea is, as I said again, that here the net present value of the debt contract is equal to 0, and of course the same is about to hold for the equity holders. Yeah. And now we use a binomial risk-neutral pricing approach just to tackle this problem. Yeah. So here you see the basic model, 100, this is the underlying, 100 and 150 in the good state and 50 in the bad state. So we can easily calculate our up and down factors for our risk-neutral probability derivation. That the up factor is 1.5, so 100 times 1.5 is 150. The down factor is 0.5, 100 times 0.5 is 50. So these are the two up and down factors. The riskless rate is given at 10%, so we may easily apply our standard equation for the risk-neutral probability in a binomial setting, and the risk-neutral probability is, in this case here, 60%. Yeah? We also have given the unadjusted probability, the not risk-adjusted probability, that is the true real probability, that is 70%. Yeah? So the first thing that we can do is we can calculate the WACC of the all equity financed firm, which is of course equal to the cost of equity in this particular case. And the idea is that the WACC is the discount rate that, if applied on the expected cash flow here, yields exactly the current price of debt plus equity, or the current price of the assets of the firm. Yeah? So you see here, this is the probability of the upstate times the cash flow in the upstate, the counter probability, and the cash flow in the downstate. If discount with a WACC over one period, we then have to yield our value of the total firm. Yeah. So, and then of course you see that the both payments and cash flows in the up and the down states are given. Here the real probability is given with 70%, the counter probability is given, the current market value of 100 is given. So you see that we can rearrange for the only unknown in this equation, and the unknown is the WACC. And if we plug in the figures, then you see that the WACC is 20%. Yeah. So if we discount the expected cash flows, which is 120 with a 20% discount rate, then we get the current value of 100. Yeah. So the next step is in this calculation, let's look for the promised yield. Yeah, that is the contractually fixed interest rate. Yeah, and here the idea is that the net present value of the credit holders must be equal to 0. That means the market value of their payments must be 55, and we can calculate the market value of their claims by first calculating the expected value based on the risk neutral probabilities, and then discount this risk adjusted expected value, this risk neutral present value, expected value, with the riskless rate. Yeah. So if we line this out, you see here in the down state with 1 minus Q, we get our 50, the cash flow in the down state. In the up state, we get, with the risk neutral probability, we get D times 1 is the redemption, and D times ICD, this is our promised interest payment that we get if the good state occurs, and that is then discounted with the riskless rate. Yeah. So if you look at these figures, then you see the only unknown in this equation, Q is known, D is known, 1 minus Q of course, XD is known, RF is known. The only unknown in this equation is the promised interest rate. So we can rearrange and solve for this, and we arrive at the promised interest rate of 22.73%, yeah, which translates into a credit spread of 22.72 minus 10%. The riskless rate is then 12.72%. Yeah? So this is the promised interest rate. This is what the debt holders get back if the good state occurs. And of course, this is not the cost of debt, yeah? Because the cost of debt has to take the bad state here also into account, where the debt holders do not receive their promised interest rate. Yeah? So we need to take the default probability and the impact of the potential default into account when calculating our cost of debt, that is the expected rate of return or the expected yield. Yeah? So, but now as we know our promised interest rate, of course, we can easily derive our expected yield or the expected rate of return and the cost of debt. Yeah? The basic idea is again that here we have our market value of our debt holders. Now we calculate the expected payments. You see here that we do this not on the risk neutral probability measure, but on the real one. Yeah, so you see here with 1 minus P, we get the 50 in the downstate. With P, we get our promised payments, redemption and interest. And if we discount this with our cost of debt, then we get the 55, our market value. Yeah? So again, the only unknown in this equation is our expected rate of return of the debt holders. So we can rearrange terms and solve this equation here, and we end up here with a cost of debt of 13.2%. Yeah? Note that, of course, the cost of debt with 13.2% are in this example significantly lower than our promised interest rate of 22.73%. Yeah? We get the same result, of course, if we now take the probabilities of the two states, and if we calculate the state-dependent rate of return for our debt holders. So in the good state, we get the promised yield of 22.7%. In the bad state, we just get 50. When relating it to our investment of 55, that translates into a negative rate of return of minus 9.1%. And if we weigh the two, then we also arrive at this 13.2% expected rate of return for the debt holders. Yeah? And finally, we have to calculate our cost of equity. So the value of our equity is under arbitrage-free conditions, the value of the firm, 100 minus the 55 of the debt holders. So the value of our equity is 45. And the idea, we can calculate the cost of equity by discounting our expected payments, here again under the real probability measure, and discounted by the cost of equity over one period, and then we arrive at the current market value of the equity. And again, the only unknown is this discount rate, that is the levered cost of equity. And so we can rearrange this equation and plug in the figures, and then you see that our cost of equity translates into 28.3%. Yeah? And finally, we may calculate the weighted average cost of capital. Now for the levered firm, by weighing the cost of equity and the cost of debt, you see that we are in a world without taxes. So that means that here the weights are 45% and 55% respectively. 28.3 is the cost of equity, 13.2 the cost of debt, and that translates again into a WACC of 20%. Yeah? And this is of course in line with the Modigliani-Miller result that says that in a world without taxes, under ideal conditions, and of course we have ideal conditions here, the WACC is independent from leverage. Yeah? So it was 20% for the all equity finance firm, it stays 20% for the debt plus equity financed firm. Yeah? So this is the graphical representation of our cost of capital in this simple example. Here you see here the WACC is constant, is always 20%, and here the cost of debt, as long as it is riskless, is equal to the riskless rate. And as long as the debt is riskless, you see here this impact on the cost of equity, that the cost of equity are a linear function of the leverage in this particular case. Yeah. But then you see when we step here from 45 to 50, then our debt becomes risky. Yeah? And then several things happen. Yeah? The first thing that happens is, of course, that the debt holders adjust the promised rate of return or the promised interest rate. You see this is this line here. And the second thing is that, of course, also the expected rate of return for our debt holder also is increasing. Yeah? Because the debt holders, of course, want to have a premium for the risk that they have to carry if the debt turns riskless. Yeah? But you can also see that, of course, the promised yield is reacting much stronger on the further increase of the debt level. You see that our cost of debt are converging against the WACC, yeah? Which makes sense if you think about it, because let's say that the firm is completely debt financed at the end, then of course the entire risk of the firm represented by the WACC, by the operating risk of the firm, is reflected in the WACC, is then of course owned by the debt holders, and that means that their cost of debt must be equal to the WACC. Yeah? So in that sense, the equity weight would be equal to 0 and the debt weight would be 100%, and as the WACC is constant, then the cost of debt converge against the WACC. Yeah? So also remarkable is the further development of the cost of equity, because you see after the debt gets risky, our cost of equity do no longer increase in any further increase in debt, which also makes sense because beyond that kink here, you see that the debt becomes risky and that any increase in risk, further increase in risk, is compensated by a further increase in the promised yield and further increase in the cost of debt. And that means that no further additional risk is then incurred by the equity holders, and that means that their cost of equity are no longer increasing at increasing debt levels. So what are the key takeaways from the simple model? Yeah? So first, we have seen that we have to distinguish between promised and expected yields, and both are important, and in our example both have to be known in order to determine the market price of the debt. Yeah? The second thing is, as we have seen, both promised and expected rate of return are increasing in risk, but of course the promised yields are way more sensitive with respect to any increase in risk, because in that sense the good state's payment then have to compensate for the losses in the bad state. Yeah? And so you have to charge even more promised interest rate in the good state just to get your higher expected rate of return when taking default into account. Yeah? So also we have already addressed that the cost of debt are converging against the WACC, and that this makes sense because if the firm is risky and produces a certain operating risk, then if the firm is at the end of the day completely debt financed, then the debt holders in that sense own the total operating risk of the firm. Yeah? So finally, we also have seen that the cost of equity in the simple model not further increase if the debt has become risky, because if any further increase in debt then increases the risk of the debt holders, they charge a compensation for this, and that means that the risk and the cost of equity of the equity holders is not affected by any further increase in the debt level in this example. Eh? And finally, and that is a very personal view on this distinction that we just have seen based on our option pricing model between promised and expected yield has nothing, and again, nothing to do with any distinction between systematic and unsystematic risk, yeah? But with possible default. Yeah? So in that sense, this is not related to any degree of diversification of any of the investors here, debt holders and equity holders. So this is completely independent. And the reason why I say this, because currently in the discussion, many practitioners relate this here, the distinction that we just have learned between promised and expected, to the systematic and unsystematic risk stemming from the capital asset pricing model. This is not true in that sense. The two things do have nothing to do with each other. So that's it for today. Thank you.